this video, I'm going to show you how investors rent out their stocks to generate income. Most people think that the only way to make money from a stock is to buy it and hope that it goes up. But did you know that when you own stocks, you can get paid while you wait? That's exactly what covered calls allow you to do. In fact, many experienced investors considered covered calls to be one of the least risky option strategies available because you're not taking on any new risk. You already own the stock. Today, I'm going to show you exactly how covered calls work, why I use them, and how I generate income from them. Before we begin, I need to give you this disclaimer. This is not investment advice. The strategies and ideas discussed in this video are for education purposes only. All trading involves risk. To help you understand the concept of covered calls, let's compare it to rental property. Imagine that you own a second house. You could simply let that house sit empty and hope that it increases in value over time. Or you could rent the house out and collect rental income while you own it. Most investors understand this concept when it comes to real estate. But did you know that you could do something similar with stocks? If you already own shares of a stock, you can rent out those shares and collect income. That's what a covered call does. Let's define a few terms. A call is an option contract. Option contracts control 100 shares of stock. So if you own 100 shares of a stock and you sell one call option against those shares, that position is covered. The word covered means that you already own the shares. You don't have to put up any extra money because you already own the stock. When you also hear the phrase writing a covered call, the word writing simply means selling. Writing a covered call and selling a covered call mean exactly the same thing. Now let's look at a real example from my own account. On Friday, June the 5th, I was assigned 500 shares of TSLL at $13.27 per share. TSLL is an ETF that tracks Tesla, and it tends to move up and down on a fairly regular basis. Because of those price swings, I like using covered calls on this position. Instead of simply holding the shares and hoping they go up, I decided to generate income from them. On Monday, June the 8th, I sold the June 12th $14 covered call. I received $32 in premium for every 100 shares. Since I owned 500 shares, I sold 5 covered calls. That brought in $160 of income immediately. Now think about that for a moment. I already owned the stock. The stock was sitting there in my account, just like an empty rental property. But instead of letting those shares sit there doing nothing, I basically rented them out and collected income. Now, let's talk about what percent of return was on that trade. Each covered call generated $32 of premium. The stock price associated with the trade was $14 per share because I sold the $14 call option. Since one option contract controls 100 shares, that means approximately $1,400 worth of stock was supporting the position. We collected $32 of premium on $1,400 position. If you divide the amount of money collected by the amount of money needed to place the trade, you get approximately 2.28% in only 1 week. Now, if a trader could consistently achieve similar returns, that would equate to an annualized return of roughly 118%. Let that sink in for just a minute. A typical savings account pays less than 1% a year. Some high-yield brokerage accounts pay between 4 to 5% annually. This trade generated more than 2% in a single week. Now, of course, future returns are never guaranteed, and not every week will look like this one, but it demonstrates the power of collecting option premium consistently. Now let's talk about what happens next. Using our June 12th $14 call option trade as an example, there are 2 possible outcomes. Outcome number 1 is on Friday, June the 12th, when the stock market closes. If TSLL stays below $14, then you keep the premium that was collected and you get to keep your shares. And next week, when the stock market opens again on Monday, you can sell another covered call and collect even more income. Now, this is often the outcome that covered call traders hope for. They collect premium, keep the shares, and repeat. Now let's talk about option number 2. Let's say on Friday, June the 12th, TSLL rises above $14. Now your shares might be called away. In other words, you would have to sell your shares at $14, but that's not a bad thing. You still get to keep all of the premium on the covered call that you sold, and you get to earn the profit from the sale of the stock moving from your purchase price up to the strike price. Let me explain. On June the 5th, I was assigned 500 shares of TSLL at $13.27 because earlier that week, I sold 5 contracts of the June 5th 1350 put for $23. On Friday, June the 5th, when the market closed, TSLL closed below $13.50, so I had to buy 500 shares at $13.50. Remember, I received $23 in premium for each of the 5 contracts that I sold, so my true cost of the shares was only $13.27 per share. Now, on Monday, June the 8th, I sold 5 contracts of the June 12th $14 covered call for $32 per contract. So if the price of TSLL is above $14 on Friday, June the 12th, I would still get to keep the premium collected, which was $32 per contract times 5 contracts for a total of $160. And I would get the profit of the sale of the 500 shares. Remember, I own them at $13.27, but the shares were sold at $14 per share. That's a 73 cents difference per share. 73 cents times 500 shares equals $365. So I would get the $160 a premium from the sale of the covered call, and I would get the $365 from the sale of the stock. And that's a total of $525. And now let me really blow your mind on why this is such an amazing way to grow your account. What do you think the return is on this example? Let's do the math. In the example, the total profit was $525. Remember, we got $160 from the premium collected on the 5 covered calls, and we got $365 from the sale of the stock. Now, the amount of money used to place the trade was $7,000 because we had to use 500 shares of TSLL at $14 per share. To calculate the return on investment, we take the money that we made, $525, and divide it by the money needed to place the trade, which is $7,000. 525 divided by 7,000 equals 7.5%. And our money was only tied up for 2 weeks, June the 5th and June 12th. So that's why I don't get real excited when a brokerage company offers me 4.9% annualized return on money sitting in my account, because I can make more than that in 2 weeks. What about your risk? Is there any additional risk of losing if you write covered calls against the stock that you own? Well, the answer is no. There is no additional risk of loss. Why? Because you already own the stock, and the shares are already sitting in your account. The stock price could go down whether you write a covered call or not. So writing a covered call does not bring you any additional risk of loss. That's why many investors considered covered calls to be one of the most conservative option strategies available. You own the stock, you collect premium, and you have the ability to generate additional income from shares that you already own. Now, covered calls are not perfect. The biggest trade-off is that your upside becomes limited above the stock price. Using our June 12th $14 call option as an example, if TSLL suddenly skyrockets, well, your gains are capped at the strike price that you selected. And remember, in our case, we sold the $14 call. So we have to sell the shares at $14. Even if TSLL skyrockets to $18 or $20 or more. Remember, a profit is a profit. The key is choosing stocks that you're comfortable owning and selecting a strike price where you'd be happy selling the shares if you're assigned. Covered calls are not a get-rich-quick strategy, rather they're an income strategy. But as we saw earlier, the rates of return can be phenomenal. And for investors who already own stock, they can be a powerful way to generate cash flow from positions that would otherwise just sit in your account. Feel free to leave a comment. I read each one myself. Thank you for watching, and we'll see you in the next video.